Hi, this is Lori Hiscock at Ruoff Home Mortgage. In my previous video on credit scores, we talked a bit about what a credit score is, how you can get a copy of yours, and what a lender uses it for. In this video, I want to take it a step further and talk about how you can potentially improve your credit score if you want, so that you can get the best terms on financing. For starters, let's talk about what your credit score is made up of. This graph shows you what FICO uses to determine your credit score. As you can see, they're basing it on several components, from your payment history to the amounts you owe, how long you've had a credit history, if you have new credit, and the types of credit used. And they weigh each of these components a little differently. Let's take it a step further now and look at those components individually. The most heavily weighed section is the payment history section. On myfico.com, you can see details of what exactly goes into that one. And here's a list from their website showing what they use to determine your payment history. Now here's something very important to talk about in this section. A lot of times when people are trying to improve their credit score, they make the mistake of actually closing things. But you cannot have a good credit score without having open, active accounts. The FICO scoring model needs to have current positive information to develop a score for you. Based on FICO's current model, in order to have a credit score, you must have at least one account on your credit report with a minimum of 6 months of history that has some activity in the most recent 6-month period. Now, collection accounts can actually do that for you. So if all you have is collection accounts, you could still have a score. But if you pay those and close them, suddenly your score is going to go away if you don't have anything else. So it's important to make sure you have additional open, active, well-paid things on your credit report. The next most important section is the amount owed section. Under this, FICO is going to look at the amount you owe on your various accounts, as well as per account type, meaning revolving, installment, etc. They are going to look at the number of accounts with balances and the proportion of the credit line used, which is an important part we'll talk about in just a minute, as well as your installment loans to a degree. Now, you may have balances on installment loans, and that's normal, but the major FICO consideration in the amount owed category is really on your revolving accounts, meaning your credit cards. FICO is extremely sensitive to the relationship between the balances on your revolving accounts and their limits. The higher your balances, the lower your score is going to be. If you max out a credit card or go over the limit, your score is going to fall dramatically, possibly more than 100 points, depending on the overall content of your report. Just the opposite, the lower your balances, the higher your score will be. FICO currently will give the best results if you utilize less than 20% of an account, meaning if you have a credit card that has a $1,000 limit, you would want the balance to be $200 or less. You're going to get the best score for that. Now, an important thing to know about this aspect of the FICO scoring is there is no residual damage to your account if you have maxed it out. For example, say you max out a credit card and then you come up with the money to pay it down to below that 20%. Paying it down will make your score pop right back up. There's no residual damage lingering if your score had a high balance in the past, so that's a good thing to know. 15% of your score is going to be based on the length of your credit history. They're basically looking at how long you've been paying bills and paying them well. Fair Isaac, which is FICO, rewards established credit. Older accounts, at least those that are in good standing, are an asset to your score. Now, when people often start trying to clean up their credit report and improve their score, they'll often make the mistake of actually closing these old accounts, and then they're going to see their score drop. You don't want to do that. You want to keep well-paid, older accounts open. Now, you can close accounts to a degree without repercussions, but you really want to think before you act on that. There's no real benefit in having more than 5 things open, so if you want to close things down to having 5 revolving accounts, great, feel free to do that. Just make wise choices on what you close. Keep open the older ones with good on-time payment histories. They're going to help your score the most. It's important to know that Fair Isaac is also going to lower your score if you have new accounts open. Taking that a step further, Fair Isaac does count 10% of your score based off of new credit items. Remember again, there's logic behind their treatment here. The new credit, along with credit inquiries, are an indicator of new accounts, and they represent a potential threat to the stability of your budget. And that also means a threat to your ability to pay the new bill that you're looking into. FICO will lower your score as a warning to a prospective lender that you may be putting your finances under stress. Now, when we talk about inquiries, a single credit inquiry can impact your score, typically between 1 to 5 points. The impact of each inquiry will depend on the overall content of your report. So the more established and stable your credit is, the less that impact is going to be. When people are mortgage shopping, they often worry about this. What's going to happen if I pull my credit? Is my score going to go down? There is an exception allowed in FICO's model based on that. You can have as many mortgage or car loan inquiries as you wish within a 45-day period of time, and those will only count as a single inquiry. So this gives you the freedom to know if you're shopping around, that's fine. Just keep it within that 45-day window from the first to the last, and it's only going to count as one inquiry. The last portion to consider is the type of credit used. This also counts for 10% of your total score. All credit is not equal in the eyes of FICO. If you want the best possible results in your score, you have to be selective. It's not enough to just open accounts and pay the bills on time. The type of credit you utilize can either help you or it can hurt you. FICO has a strange bias against consumer credit, things like store cards or retail accounts, or the type of financing you get when you get furniture or appliances or electronic stores, that type of thing. This type of debt, it can provide less benefit when you're paying on time and can provide more damage if you're not. So just be aware if you have those type of things, be careful to not have any dings or late payments on those, and you are much more benefited by having the more traditional type of revolving credit. That would be things like your standard credit cards, your MasterCard, Visa, American Express, Discover. In addition, a balanced mix of accounts can benefit your score. You can obtain a very good credit score with just revolving debt, but the presence of automobile loans, mortgages, all of those type of installment things can make your score even stronger. One additional note on this topic, a lot of times my clients want to get a credit card, but because of their past history, they can't qualify for a credit card, and that's stopping them from building the positive credit history they need to build. If that's your case, this is an option you may want to consider. A lot of banks will offer a cash-secured credit card. This is a true credit card where they, for example, give you a $500 limit, and in exchange, you put $500 in the bank with them that they tie to that credit card. If you ever don't pay it, they will take your savings account and pay it off. This is a way to get a card when you might otherwise not qualify. It's just important if you go this route, make sure the bank you're doing it with reports it to the credit bureau. The whole point is to have this reported to the credit bureau and build a positive history for you. So make sure they do that. Well, hopefully this information helps give you some details on what goes into that credit score and maybe show you some ways that you could improve yours if desired. If you have additional questions on this or on any other aspect of home financing, please know I'm always happy to help. You can drop me an email or give me a call. Thanks and have a great day.